Over 55% of the investment real estate owners in the US right now are age 60 and over, what's considered a baby boomer. And this is a tremendous opportunity for many investors in today's market to use seller financing to benefit both the seller and the buyer. And today we're going to talk about the best ways to do that. Seller financing can actually take a couple of variations, but there's a really good reason why it's in the best interest of both a seller and a buyer in the right situation. Typically, those situations are where most baby boomer owners are finding themselves right now, where they have the property paid off and no longer have a mortgage. They want the continued income, but they do not want the headache of owning and managing a property anymore. But one of the biggest barriers for a lot of those owners to sell is the fact that they'd have to pay a lot of taxes. So how can you address their pain points in order to secure great financing terms for the buyer and also help the seller in the process? So one of the best ways to do this is through a seller financing agreement. And there's some nuances there that we're going to talk about today. There's basically three different ways that you can structure seller financing through different legal avenues that are all variations that have pros and cons. So the first one, and I'd say mostly in the favor of the seller, would be a master lease agreement. So if you're a buyer, let's say you want to purchase a property, have limited capital, but you know that that property can really benefit from a tremendous value add, whether that's fixing it up, adding additional units, leasing it up more, increasing rents really dramatically, whatever that is. Sometimes a master lease agreement is the best way to do this, which is simply just what it sounds like, a lease that covers the entire property. You, as the buyer/tenant, assume all responsibility for payment of costs, managing tenants just like you would if you own the property. This gives you the ability to go in and basically address whatever problems there are with the property. And then once they are addressed, replace the master lease with a traditional purchase, whether that's through seller financing or bank financing and what have you. The second option would be a master installment sales agreement. And that is basically a purchase, but it is paid over time. So what typically happens is that a formal agreement is put together where the buyer agrees to make payments to the seller, just like the seller's holding a mortgage. They pre-negotiate the length, the interest rate, and all those terms. The buyer takes possession just like you would with a traditional purchase, but the main difference is that the deed is not recorded as transferred until the buyer completely pays off the property at the end of the sales installment agreement. So this fact is key because it basically means that the buyer defaults. The seller does not have to go through the process of foreclosing and taking the property back, which protects them from default, and the buyer still has possession of the property just like they would normally, but there's a little more flexibility there. So the reason that a seller would want a sales installment agreement, not just because of the easier foreclosure terms, but because of the way a sales installment agreement is recorded for their taxes. So the difference in a capital gain tax bracket between 15 and 20% is around the $518,000 to $583,000 number for most people here currently in 2026. So if the seller sells let's say a $2 million property, the entire of that purchase is moved into the 20% capital gains tax bracket, and most sellers have significant capital gains. However, if they delay that purchase over, let's say, a time period of 10 to 15 years, then they can oftentimes stay below in the 15% capital gain tax bracket, thereby reducing their taxes and spreading it out over multiple years. So it can be a pretty significant benefit from a tax perspective for a seller. For a buyer, it's pretty much the same thing regardless. So if it can give a benefit to the seller in that method, why not? Then the third way that you can do seller financing is with a traditional sale and mortgage. So this is where the deed is completely transferred, and instead the seller receives a mortgage just like they would if they were a bank, with all the same protections. They would have to go through the foreclosure process if they needed to take it back if the buyer defaults. But the key difference here is really just the legal consequence. It really doesn't make a whole lot of difference for the buyer, unless, of course, they default. And the seller, instead of still owning the property, now has a mortgage and a note. So there might be some reasons why a seller would prefer that method depending on their situation. So it's really important that if you're a buyer going into a situation where you want to educate the seller, make sure that they consult with their professionals, their CPA and their attorney, and that they understand the difference so that you can work out a deal between the two of you. So the reason, of course, that buyers love seller financing is because everything's negotiable. You can negotiate the interest rate, the term, the length, the down payment, all those things. And there's just way more flexibility than you would have with a bank. Not to mention the fact that you get to work together and kind of erase that friction when you have a bank in place as well. So it's a great opportunity for both the buyer and the seller to get something that they want and need. And those opportunities are growing in number because of the baby boomer generation retiring, wanting to hand off their real estate to the next generation. So I hope this video brought you some value. If so, please like, comment, and share. And if you're looking for investment real estate in Pennsylvania or Maryland, please reach out to us. We're happy to help.